Gold and Bitcoin are two of the most well-known assets in the world today. Both are prized for their ability to store value and act as a hedge against economic uncertainty. While they share some similarities, there are also significant differences between these two assets. In this comparison, we will examine 14 key criteria for evaluating gold and Bitcoin, and explore how they differ in each area. History. Gold has been used as a store of value and a medium of exchange for thousands of years. It has been used as currency by many ancient civilizations, including the Greeks, Romans, and Egyptians. Gold has also played a role in modern finance, serving as a hedge against inflation and economic instability. Bitcoin, on the other hand, is a relatively new invention, having been created in 2009 by an unknown individual or group of individuals using the pseudonym Satoshi Nakamoto. While Bitcoin has only been around for a little over a decade, it has already gained a significant following among investors and enthusiasts. Physical presence. One of the key differences between gold and Bitcoin is that gold is a physical asset, while Bitcoin is a digital asset. Gold can be stored in the form of coins, bars or jewelry and can be kept in a safe place, such as buried in the garden. Bitcoin, on the other hand, exists only in the digital realm and is stored in a decentralized network of computers called blockchain. More on this later. Divisibility. Gold can be divided into smaller units, such as ounces, grams, and even milligrams. This makes it easy to buy and sell gold in small amounts. Bitcoin is also highly divisible. Each Bitcoin consists of 100 million satoshis. This allows transactions of any size, from small micro payments to large transfers of wealth. Note, however, that to buy Bitcoin we only need to link our wallet to an exchange and we can buy anywhere in the world. Gold, on the other hand, cannot be bought in such a simple and fast way. Transparency. One of Bitcoin's unique features is its transparency. Every transaction that takes place on the Bitcoin network is recorded on the blockchain, a public ledger that can be viewed by anyone. This makes it easier to track Bitcoin's movement and ensures that transactions are secure and tamper-proof. Gold, on the other hand, is not transparent in the same way, and tracking ownership of a particular piece of gold can be difficult. It is also important to remember that there are regulations regarding the transfer of gold across borders. Bitcoin's advantage, on the other hand, is that if you know the 15-digit private address to your wallet you can go anywhere without worrying that your cryptocurrencies will be taken from you. Security. Both gold and Bitcoin are considered safe assets, but they achieve security in different ways. Gold is physically safe, as it can be stored in a variety of secure locations depending on your imagination. However, it is important to remember that in the past the US government has confiscated gold from its citizens. This event occurred in the 1930s during the so-called gold standard. In 1933, as a result of the tightening of financial regulations by President Franklin D. Roosevelt, all US citizens were required to surrender their gold in exchange for dollars, which were then under government control. The purpose of this action was to ensure the stability of the dollar and prevent the government from further losing its gold. Those who did not comply with this order were subject to criminal and financial sanctions, and their gold could be confiscated. Bitcoin, on the other hand, is secure because of the cryptography that underlies the blockchain. Transactions on the Bitcoin network are verified by a network of computers called nodes, which use complex algorithms to ensure that transactions are legitimate and tamper-proof. We can store Bitcoin on a hot wallet, such as MetaMask, or on a cold wallet, such as Ledger. Bitcoin can't be deleted. Stability of value. One of the key criteria for evaluating any asset is its stability of value. Gold has historically been considered a stable store of value, with its price fluctuating over time, but generally maintaining its purchasing power over the long term. Bitcoin, on the other hand, has been known for its instability, with its price fluctuating wildly over short periods of time. While Bitcoin has the potential for significant returns, it also carries a high level of risk. Bitcoin can also be used as a potential hedge against inflation, as its supply is limited and cannot be manipulated by any central authority. However, the relationship between Bitcoin and inflation is not straightforward, and many factors can affect its price. Availability. Gold is widely available, with deposits on every continent except Antarctica. However, the cost of mining and extracting gold can vary widely depending on location and the technology used. Bitcoin, on the other hand, is available to anyone with an internet connection and a digital wallet. This makes it easy for anyone to buy, sell, or trade Bitcoin, regardless of location. Note that Bitcoin is also mined by so-called miners, but on the basis of solving a computational problem through their crypto diggers. Regulatory environment. Both gold and Bitcoin are subject to regulatory oversight, but the nature of that oversight is different. Gold is subject to a variety of regulations and restrictions, including import and export regulations, taxes, and environmental regulations related to mining and refining. Bitcoin, on the other hand, is subject to a patchwork of regulations around the world, with some countries adopting a more friendly regulatory environment for digital assets than others. Supply. The supply of gold is finite, with new gold deposits becoming increasingly difficult and expensive to find and mine. This means that the supply of gold is limited, which can contribute to its stability as a store of value. Bitcoin, on the other hand, has a fixed supply of 21 million coins, with new coins being created through a process called mining. The supply of Bitcoin is expected to reach its limit in the year 2140, making it a deflationary asset over the long term. Environmental impact. Both gold and Bitcoin mining can have a significant impact on the environment. Gold mining can lead to deforestation, water pollution, and soil degradation, as well as the use of toxic chemicals such as mercury and cyanide. Bitcoin mining requires significant amounts of energy to power the computers that process transactions and maintain the blockchain, which can contribute to carbon emissions and climate change. However, Bitcoin mining can also be environmentally neutral by using renewable energy such as geothermal. Accessibility for individuals. Gold and Bitcoin differ significantly in terms of accessibility for individuals. Gold can be purchased in small quantities, such as coins or bars, but the cost of entry can be high, with prices often exceeding $1,000 per ounce. Bitcoin, on the other hand, can be purchased in small amounts, with even a fraction of a Bitcoin, a Satoshi, being worth a small amount of money. This makes Bitcoin accessible to anyone with an internet connection and a few dollars to spare. Conclusion. Gold and Bitcoin are two very different assets with different strengths and weaknesses. Gold has a long history as a store of value and a hedge against economic uncertainty, while Bitcoin is a newer asset with a higher potential for returns but also a higher level of risk. While both assets have some similarities, such as their use as investment assets and their susceptibility to geopolitical risks, they differ significantly in terms of their physical presence, transparency, and regulatory environment. Ultimately, the choice between gold and Bitcoin will depend on an individual's investment goals and risk tolerance, as well as their preferences for physical versus digital assets. Join me at crypto exchange, Bybit, and earn exclusive rewards with Bybit's referral program. Plus, up to 5,030 USDT in bonuses await you. In my opinion, it's one of the best exchanges with some of the lowest fees. Thank you.